Hey, and welcome to the video for Workshop 3. We're talking about Chapter 3 and 4 this week, so let's go ahead and get into the things that you need to know. For Chapter 3, we're talking about the difference between the cash basis and the accrual basis. Hopefully you've read a little bit about that. We've talked about it a little bit earlier in the course, but essentially what the cash basis does is it recognizes revenue and expenses whenever the cash transaction takes place. Now, the accrual basis, which is GAAP, remember that's generally accepted accounting principles. Their accrual basis is going to record the transaction whenever the revenue is earned or the expenses incurred, not when the cash takes place. That would be a second transaction whenever the cash takes place if it's at a later time than when the transaction occurred. So let's look at an example. Here's a little timeline, 2010 and 2011. So let's say that we sold some services in December and received in January. Okay, so under the cash basis, when would that actually be recorded as revenue? It would be recorded, I'm assuming December 2010 and January 2011. We recorded under the cash basis when we received it over here. So is that GAAP? No, that's not GAAP because that is not when the actual transaction occurred. It occurred in December of 2010, so it should be recorded in the 2010 period rather than 2011. Now, what's the problem with the cash basis method here? Well, this leads to manipulation. We can actually request being paid here in 2010 and record all our pluses in 2010 and have a really good year here and delay all of our payments until January 2011, put all our minuses here. But really, this is not good matching. Remember, matching is one of the concepts that we talked about in the first week, one of the main accounting principles. So we want to match them together, put our pluses and minuses for the same transactions in the proper periods, 2010, 2011, whenever those transactions take place. Okay, on the study guide, hopefully you've had that printed out. There are 4 different types of adjusting entries that are related to our accrual basis method. So let's look at the first one, prepaid expenses. What would a prepaid expense be? That would be like something that we pay in advance that is not actually incurred yet. So if we prepay rent, you know how you might pay 3 months in advance on January 1st, but you pay for January, February, and March, for example, or it might be for a full year for a business. So what would we do in those cases? Well, we're going to set it up as an asset. A prepaid expense is an asset, so we would call it prepaid rent. And obviously, we're paying cash, so the cash is going to be credited. We'll call it $3,000 there. And we'll say this is for 3 months, January, February, and March. We set it up as an asset. We'll put a little bracket there showing the A. What do we do at, this would be 1/1. What do we do at 1/31 at the end of the month when we're doing our monthly financial statements? Well, we need to take this out of the asset and move part of it to expense since it has been used up. So we'll debit rent expense and prepaid rent, same account up here, but we're only going to do it for 1,000, the part that's been used up. 1,000. You see the way that this properly matches? Now at the end of 1/31, what is it going to be in our T accounts? Here's our prepaid rent. We started with 3,000. We took 1,000 out with this credit. So we have 2,000, which is the amount that relates to February and March that is not incurred as of January 31st. So that's an example of a prepaid expense. Let's look at deferred revenue. What would that be? That's the second type of adjusting entry in our grid there. This is where we receive cash for something that we have not earned yet. So somebody pays us in advance. Now this time, we're on the other side of the transaction. We're kind of like the landlord. Okay, so we receive cash coming in and unearned revenue. What type of an account is this? It's a liability. We haven't earned it yet. And we'll do the same type of transaction with the 3,000. 3,000, so assuming that we're the landlord, we receive the cash in advance on January 1st. What happens on January 31st? Well, we've let that tenant stay in our building for that time. So part of this unearned revenue is now earned. So we'll back it out. Unearned revenue is going to be debited. And what is the actual credit? It's the opposite of what it was a minute ago when we expense it. Since we're the landlord, now it's revenue. So revenue for $1,000 for 1 month's rent that we have actually earned at this point. Okay, so this is a liability. This is on the income statement. Same thing. How does this show up in our T account for our unearned revenue on the balance sheet? Well, we put a credit in there of 3. We took 1 out with the adjusting journal entry, and now we have 2 showing up at 131 that relates to February. Relates to February and March going forward. Okay, and that could be something that you would do on an annual basis, or if you do monthly financial statements, you would do the same thing per month. So let's look at the third one, an accrued expense. Now what is actually going on is these are being, on items 3 and 4, they're being incurred and earned before the cash is taking place. Previously we had the cash coming in first, now the cash is coming in later after we've actually incurred or earned it. So an accrued expense, an example is you receive a utility bill before you pay it. So you receive it in December, but you pay it in January. But we want to make sure that we get that expense in the proper period in that December period. So we're going to set it up with the expense and the liability. When we pay it in the following period, we're going to move that liability. We're going to remove that liability and pay cash. So an example, we'll say utility expense for $100. We received the bill, say at the end of December 31st. We set this up as utility payable, some kind of liability for $100 there. You know, we would have our balance sheet date here at 12/31. Say we pay it on January 5th, 1/5. Utility payable, cash for $100. You see how that came into the payable? We showed it on the balance sheet, and we properly recognized the expense in the proper period, and then we took it out in the following period on January 5th. Opposite side of that, let's look at the final transaction, accrued revenue. Now this is where we have actually earned something. Like say we're an accountant and we have an accounting firm and we send out a bill for our services, but they haven't paid us yet. So what is that going to be? Instead of a liability, it's going to be an asset when we debit our first transaction. So this would be account receivable. Say we send out a bill for $500 for our services, $500. And the credit is going to be revenue, $500 there. So we set up the asset, we recorded it on the income statement for the 2010 period. We'll say this is 12/31. We received this on 1/10. What do? Well, we have this account receivable we need to take out. So we receive the cash in for $500, and we take out the account receivable there for $500. Okay, so there's plenty of examples of these accounts. Make sure you understand the grid on the middle of page 1 on the study guide. I've tried to walk you through a couple of examples of those, which will hopefully help out. Now let's talk about temporary versus permanent accounts. Now, our income statement accounts are temporary accounts. Sometimes you hear those as nominal. They're temporary because we close them out every period. So at the end of the period, we're going to go through a closing process where we close out sales and expenses, those accounts that build our income statement, so that we can start those over in the future period. Now, this doesn't apply to the permanent accounts that are on the balance sheet. So our building, we don't want to close that out because we have that as an ongoing asset, for example. Same thing with liability and equity. We just want to close out our revenue and expenses. We're going to move those to what we're going to look at retained earnings later on. But just make sure you know the difference between a temporary and a permanent account. The main idea is that the temporary accounts are our income statement accounts. The permanent accounts are our real accounts. The accounting cycle is on page 110. Make sure you understand that. We've kind of walked through most of it with receiving a transaction data in, making a journal entry, posting it to an account, and then doing adjusting entries, closing entries, doing financial statements. Make sure that you understand the full cycle of how it rolls through from period to period. That's just the basic fundamental piece that we want to look at. The classification categories on 111 through 113. If something is going to be received within a year or used within a year, we put that in the current bucket. If it's a long-term piece over a year, we put it in the non-current bucket. Now let's look at chapter 4.